Trump wins and is once again back in the White House, and Justin Trudeau took a walk in the snow just like his dad. But how will this affect you as a Canadian retiree? I'm Joe Masick, cross-border portfolio manager and investment advisor for IA Private Wealth and IA Private Wealth USA. And today I'm going to explain to you how you as a retiree can not only survive the next 4 years, but thrive. Let's get started. Anyone watching the political scene in Canada and the US over the past little while has witnessed nothing short of a storm of change. With Trump's absolutely dominant win south of the border, he now holds what they call a governing trifecta: control of the presidency, the House of Representatives, and the Senate. This gives him a clear mandate and virtually unfettered power to shape the next 4 years. North of the border, things are not looking that much different, as Liberal leader Justin Trudeau has resigned, and with that departure, it opens up an opportunity for a possible election in Canada sooner than later. And according to 338canada.com, the Conservatives are on track to absolutely crush it in the next election, securing an estimated 236 seats, a landslide victory well beyond the 172 seats needed for a majority. The Liberals are set to be annihilated, with projections showing them to being reduced to a staggering low of just 35 seats, down from 153 seats. I don't want to sound like I'm stating the obvious here, but this marks what appears to be a brutal downfall for Justin Trudeau and the Liberal Party, and could signal the end of Liberal dominance in Canada for the foreseeable future. So if you're a Canadian retiree, what do? Well, if you're a conservative at heart in the US, you are probably celebrating, and you might even be breathing a huge sigh of relief. And in Canada, it looks like you will be celebrating soon, as the Liberals look like they will be soundly defeated north of the border as well. This is the kind of political victory as a conservative that you savor, because it doesn't come along very often. Now, if you are a Liberal or a Democrat, you're probably feeling pretty uneasy or anxious about the next 4 years. With Trump at the helm in the US and Pierre Poilievre poised to take control in Canada, the political landscape for you is, well, quite scary. I know this because I've already had a few calls from clients asking if they should take drastic steps like moving everything to cash to protect their investments. And if you're wondering what the answer to that question is, the short answer is no. You should not move to cash just because of who's been elected in the US or in Canada. Whether it's a Republican or a Democrat in power, history has shown that going to cash based on political outcomes is almost never a smart move. Now, I will go into much more detail about that, but here's the bottom line. Depending on your circumstances, staying invested in strong, high-quality businesses has consistently outperformed trying to selectively invest based on who's in office. So I definitely don't want to say that I've seen it all, but in my over 25 years as an advisor and 27 years in the business, I've personally seen a lot of market history. I started my career under George W. Bush, then came Barack Obama, Trump 1.0, Joe Biden, and now we're heading back into Trump 2.0. That's 12 years of Republicans and 12 years of Democrats. In Canada, I started under the Liberals with Jean Chrétien, Paul Martin, and then finished off with Conservative leader Stephen Harper, and finally Liberal leader Justin Trudeau, having only 9 years of Conservative leadership in those years. And if you really examine it closely, you will find that the markets really don't care who's in charge. When I first got into the business, the TSX was at approximately 6,700 points, the Dow Jones was around 7,800 points, and the Nasdaq closed at the end of 1997 around 1,500 points. As of today's writing, the TSX closed at 24,588.58 points, about 3.6 times the value. The Dow Jones closed at 42,518 points, about 5.45 times the value, and the Nasdaq closed at 20,939 points, almost 14 times the value. And by the time this century is out, I personally predict that all three of these indices will cross 1 million points. Why? Because I believe the most amazing American and Canadian businesses imaginable, Walmart, Amazon, Nvidia, Spotify, Canadian banks, real estate investment trusts, these are all world-class companies that are adept at generating profits no matter who's in power. These companies' employees and management work tirelessly to help ensure that your money invested in them will grow and that you can retire in comfort. And before we totally dive into the next 4 years, I do want to set the record straight. This video isn't going to be about picking sides, Republican, Liberal, Conservative, or Democrat. It's designed to be a hard look at what Trump's re-election and a possible Conservative win in Canada could mean for Canada's economy and how it will affect you as a Canadian retiree retiree. So before the comments start rolling in about how Trump is amazing, or whether Harris would have been a far better choice, or how you feel about Pierre Poilievre or Trudeau, I want to clarify. This channel is not a political channel, and I'm not going to get into the pro-liberal or pro-conservative debate. I won't stop you from commenting on who you like in the comment section, but just so you know, I'm not going to comment one way or the other should you happen to voice your political opinions. Now, I'm going to give you one further idea that you really want to think about, is whether or not you should hit that like button and the subscribe button for the YouTube algorithm, as it really helps out my channel. Over 90% of my watch time is generated by viewers who are not subscribed. So please consider liking and subscribing, as it really helps my videos get out to many more incredible viewers like you. Thanks again in advance for your support. Now, for this video, I'm just going to focus on what information we have currently as investors and how we can use this information to help structure our portfolios to take full advantage of the situation as a Canadian retiree. So let's start with the US, as we have a clear result in the election, and let's take a closer look at what history suggests will happen with different types of governments. According to a recent CNBC article, what they found from a historical sense is that a divided US government has generally been more favorable for stocks. When a Democratic president leads with a divided Congress, the S&P 500 has averaged an annual return of 15.7%. Likewise, under a Republican president with a divided Congress, returns have averaged 13.7%. In both cases, the stock market has performed better compared to the periods of single-party control. And when we look at those single-party numbers, we find that under Democratic control, the average return for the S&P 500 was 8.6%, while the Republican control, the average return was 6.7%. It is important to note, however, that the Democrats held control for 20 years compared to just 10 years for the Republicans, so the numbers could be a bit skewed. If the timeframes were a little more equal, I personally believe the returns would likely be closer in nature. However, the real takeaway from all of this data is simple. No matter who's in power or what the structure of the government is, the markets have historically gone up in every type of scenario mentioned in the article. So if you as an investor had moved to cash based on who got elected, it would have been a costly mistake. That said, we're heading into a period here where Trump and the Republicans are in full control. So now let's take a closer look at what Donald Trump promised during his campaign. Now, Trump did promise quite a bit, and I can talk a lot more about how I think things are going to unfold, but I don't want to make this video 2 hours long. So for this video, I'm going to focus solely on the 3 things that I think are most likely to affect Canadian retirees, which I believe are energy prices, the currency exchange, and tariffs. These are the Trump promises that I think will have the most significant impact on your retirement as a Canadian. And I'll break down how each one could potentially benefit you over the next 4 years. Drill, baby, drill.
That is why today I will also declare a national energy emergency. We will drill, baby, drill.
Now, this is the one promise that I think will likely have the most profound impact on Canadian retirees going forward. Trump wants to crush inflation by slashing energy costs. How is all this going to work? Well, his plan is to ramp up oil production and flood the oil market with supply, aiming to drive energy costs down substantially. Since energy prices materially impact nearly everything from cooking your meals to driving your car, heating your home, and transporting goods worldwide, lowering oil prices will likely help ease inflationary pressures. If Trump follows through on his drill baby drill promise, it will very likely put a lot of money in everyone's pockets. Not just Americans' pockets, but Canadian retirees' pockets as well. You will very likely see lower living costs, allowing your retirement savings to go a lot further. However, what might not be so obvious to many Canadians is how this promise could be a double-edged sword. And the problem lies with the Canadian dollar versus the US dollar. While lower energy costs in Canada will probably reduce your expenses at home, for those snowbirds looking to escape the harsh Canadian winters, or for certain amazing cross-border advisors looking to build their businesses in the US, it probably increases their costs south of the border. You see, what many people don't realize is that the Canadian dollar is largely considered a petrocurrency because roughly 80% of his movement is tied to oil prices. Canada's currency rises and falls in close correlation with the energy markets, as you can see in this chart from Macro Micro. The correlation is well documented, especially over the last 25 years. The remaining 20% of the Canadian dollar's value versus the US is heavily influenced by different differences in the interest rates on the short end between Canada and the United States. Essentially, how our short-term interest rates move vis-a-vis the US Federal Reserve and their short-term rates. So how does this scenario look? Well, it's no secret that the Canadian economy has been struggling more than the US, and this could create the perfect storm for the Canadian dollar. With interest rates likely to drop further and faster in Canada than the US, combined with the likelihood of lower oil prices, it's not looking very good for the Canadian dollar. And as you can see from this chart from XE, the Canadian dollar hit a high of about 74.5 cents in October when it seemed like the Democrats were leading in the polls. And since then, it's become pretty obvious from how the markets are reacting to the challenges facing the Canadian economy and the likelihood of lower oil prices as the dollar has dropped significantly from that high of 74.5 cents to now roughly 69 cents as of this writing. If Trump is successful in driving energy prices lower, the Canadian dollar will probably drop even further. We could see it hit the mid 60-cent range or even dip into the high 59-cent range. For Canadian snowbirds, this will likely make US travel significantly more expensive. So if you're a snowbird planning to spend time in the US, now might be a good time to convert more of your Canadian dollars into US dollars, as they're likely to become even more costly over the next 3 or 4 years. Now, with all that said, if my thoughts on the Canadian dollar being weaker are correct, it could eventually be a big win for Canada. You see, Canada is a net exporter to the United States. We sell more goods to the US than the US sells to us. And with a lower Canadian dollar, our goods and services become significantly cheaper for Americans to buy. This should give us a huge boost to demand, potentially driving some economic growth in Canada over the next 4 years. So while the short-term outlook might be tough, this could set the stage for a much brighter future for Canada's economy in the long run. Okay, finally, let's address the thing that's on most Canadians' minds these days, the Trump tariff threat. And unless you've been living under a rock or trapped in the Canadian wilderness without cell service, you know that Trump has threatened to impose a 25% tariff on Canada if we do not secure our border and significantly increase our military spending to honor our NATO commitments. Now, while this might sound alarming, I don't believe Trump actually wants to put such steep tariffs on Canada. What he really wants is to keep his promise to secure the border and help ensure Canada is doing its part in meeting NATO commitments on military spending, something that I think that most Canadians are behind. So I think if Canada can take steps to secure the border and address some of the concerns that Trump has raised, we can avoid a trade war. But if tariffs do get imposed, it's almost certain that Canada will retaliate, which could escalate into a full-blown trade war. This is definitely something we all want to avoid, and the reality is the US is Canada's largest trading partner. Both countries thrive when we have free trade. Tariffs would only harm both economies, and I believe it's in everyone's best interest to keep those trade lines open. However, if a trade war were to develop between the US and Canada, it would likely have significant repercussions for both economies. It would probably start with tariffs being imposed on goods like steel, aluminum, agricultural products, and automobiles. In the short term, prices for goods in both countries would likely rise, and disruptions in supply chains would probably happen. Exports would be reduced, and US manufacturers who rely on Canadian raw materials or markets for their goods could be hurt. Canadian businesses would also struggle to keep costs down. The Canadian dollar would probably also weaken further, making imports to Canadians even more expensive and further raising the cost of living. In the end, I believe and hope that the US and Canada will take a reasonable approach to this, understanding that Canada is going through a period of political change, and given the current dynamics, I'm optimistic that future negotiations between Canada and the US will be favorable. Many premiers, including Danielle Smith, have already stepped up to try to help ensure the relationship remains strong between us, advocating for collaboration and a positive path forward. Here's the bottom line. No matter what political changes come our way, staying invested in great businesses is generally your best bet for a successful retirement. Markets have shown themselves to be very resilient no matter who's in power. As a Canadian retiree who's not a snowbird, things could get really good for you, especially if we avoid a trade war. With energy prices set to go lower, your retirement could benefit benefit a lot from these changes. Staying focused on your long-term goals and investing in quality companies can help you secure the future you deserve. If you're a snowbird, consider picking up a few extra US dollars on days where you can get a great deal. This can help you offset the costs down the road of heading down south and give you a lot more flexibility. Do you want to see why I think Dave Ramsey could have been right? Or maybe you just want to see my latest upload? Well, I've got everything all queued up and ready for you. Click here for more amazing financial insights. I'll be waiting. We'll see you soon.